Hey everyone, and welcome. So today we're going to talk about something that quietly sucks time and money out of almost every single business: managing employee expenses. It sounds simple, I know, but as you're about to see, the old way of doing things can hide some really serious costs. Does this look familiar to anyone? Piles of receipts, endless expense forms, and a finance team just about ready to pull their hair out. I mean, if you've ever paid for a work lunch with your own cash and then waited weeks to get that money back, you know exactly what this feels like. It's a huge drag on everyone's time and morale.
And look, this is a headache for companies all over the world. But what if I told you that in certain places with certain rules, this standard process of just paying your employees back can create a massive, totally unexpected tax bill for everybody? We're going to look at one specific case that makes this incredibly clear.
Okay, so first things first, let's break down the traditional model. You know, the one that causes all the trouble in the first place. It's that classic cycle where an employee spends their own money and then has to wait for the company to make them whole again. It's such a clunky process, right? Your employees are basically giving the company an interest-free loan every time they buy something for work. Then your finance team has to become detectives, manually chasing down every single claim to match it with a receipt and a policy. This isn't just slow, it's a major bottleneck that just grinds everything to a halt and creates this huge administrative weight on the company.
So, we've established it's a pain. But now, let's see how that administrative headache can blow up into a really serious financial problem. We're going to zoom in on a scenario in Israel, where the tax system completely flips this entire process on its head.
Okay, here is the absolute core of the problem. It's a little something called a taxable benefit. In this specific legal situation, when a company pays an employee back for something they bought, the government doesn't see it as a reimbursement. They see it as extra income, just like a salary bonus. And what happens to income? Yep, it gets taxed.
This creates a total lose-lose situation. For the employer, bam, they get hit with higher payroll taxes because they're paying out this extra income. And the employee, this is the wild part. They get taxed on the money they were just getting back. They use their own cash for a legitimate work expense, and now their take-home pay is actually lower because of it. It's a system that punishes everybody.
So after all that doom and gloom, you're probably thinking there has to be a better way, right? Well, you'd be right. The solution is actually surprisingly elegant. It's all about changing the flow of money so that the word reimbursement just isn't even part of the conversation anymore. And that's where the corporate debit card comes in. Now listen closely. This is not a credit card. It's a payment card that lets an employee spend money that is already sitting in the company's bank account. The most important difference here is that the employee's personal money never ever enters the picture.
And that distinction between debit and credit, it is absolutely crucial. A corporate credit card is about borrowing money. It's debt. A debit card, on the other hand, uses cash on hand. For the business, this means no new debt, no interest payments, and way more control over spending, because you can only spend what you actually have.
Okay, so that sounds great in theory, but how complicated is it to actually make this switch? Well, the whole process is designed to be incredibly simple, taking away all that usual friction you get when you're trying to adopt a new financial tool. Honestly, getting started is a breeze. First, there's a quick registration. Next thing you know, custom-branded cards show up for your team. And then you just activate them, load them with funds, and boom, your employees are ready to make approved purchases without ever having to reach for their own wallets. The whole idea is to get rid of any setup headaches.
All right, let's get to the good stuff. What is the real-world impact of making this switch? Let's look at the payoff, because the advantages go way beyond just solving that one tax problem. This genuinely improves life for everyone involved.
You can really see how this is a win-win for everyone. For employees, it's a huge relief. No more being the company's personal bank, right? But for managers, this is a game changer. You get total control to set exact budgets, you completely eliminate all that boring reimbursement admin, and you make sure you're compliant with tax rules automatically.
And hey, don't just take my word for it. Listen to what an employee, Tal Gadot, had to say. Finally, I can make work-related purchases without waiting for reimbursements. This card makes my life so much easier. It just removes that whole layer of financial friction from their daily job.
And you know, this tool is really built for how we work today. You got a global team? No problem. It's accepted in over 60 countries. You want to see everything in real time? You got it. You can even set specific spending restrictions, like this card only works at these approved stores. It's all about giving you control and flexibility.
So let's bring this all the way back around. By using a corporate debit card,
The company is directly funding an expense, not reimbursing it. And that one simple change in the process means the money is never, ever considered a taxable benefit for the employee. That whole tax nightmare we talked about, it just evaporates.
And that really gets you thinking, doesn't it? This whole explainer focused on one very specific tax issue, but the lesson here is so much bigger. It really forces us to stop and ask, beyond taxes, what other hidden costs in time and morale and actual money are buried in our own company's daily processes.